Right, just press and record. Okay, we're now recording, guys. Just on countdown mode. Right, that's 4 o'clock then, guys. All set?
Yeah.
All sitting comfortably? Good. Okay, then right, let's start the webinar. Here we go. 1, 2, 3, and we're running. Right, and just hopefully wait for some participants to arrive. Ah, great. Now we've got some participants arriving. So as people are joining the webinar this afternoon, I would just like to start with a few housekeeping rules, and just to let everybody know that this webinar is being recorded this afternoon. It will be available on the Thrings website at a later date. So if there are any points within the webinar that you feel you've missed and you want to pick up on, by all means, go and check those out. Or alternatively, if you have any colleagues or any other acquaintances that you feel might benefit from the webinar and viewing the recording, please feel free to share with them. So as I say, the webinar is being recorded this afternoon. So that's our main housekeeping point started. So I'd just like to start things off by welcoming everybody this afternoon to our Thrings webinar. My name is Chris Elias. I'm a relationship director with Thrings. I have to admit, I'm not a lawyer. I come from a corporate banking background. So this afternoon's webinar is going to be interesting for me, really, and in terms of it sort of covers a subject which I know a little bit about. So I'll probably chip in a bit as well as we go along, as our main speakers are talking. This afternoon's webinar is part of the Thrings Business Health Matters series, which is a series of webinars we've been running all the way through the pandemic. And we've just been sort of covering sort of important topics which we feel our clients would be interested in whilst they've been during lockdown. And you know, we've covered a range of topics from contract law to personnel issues to private client matters, what's happening in the agricultural sector. So a whole breadth of topics which we're building up into a nice sort of information base and library for people to look at and join and use as a reference point. So that's a little bit of a background in terms of the series. Today's webinar is focused on the banking and finance sector. Clearly, you know, that's a very broad church. So what we'll try and do really is just sort of keep it a little bit more specific, so we can just comment in terms of a couple of the key aspects and focus on a couple of the key points which have sort of come out of our experience of what's been happening in the sector over the last 15 or so months. We've got 3 speakers for you today, and we'll be mainly looking to cover 2 main topics. First up, we have Charlotte Doolin. So Charlotte, wave from you, please. Yeah, that's excellent. Well done, Charlotte. Good to have you. Charlotte's a senior associate in our commercial property team. Much of Charlotte's work involves secured lending, and Charlotte's going to give us an insight into the growth of private banks in the sector, which I think we've seen quite a bit more of over the last 12 months or so. Right, now if this was a pantomime, and it might well turn into one at a later date, who knows? Charlotte is definitely beauty. And now we come on to the 2 beasts that we have here. We have a hairy beast, who's Mike Tomlin, thank you, Mike, who is head of the banking and finance team in Thrings. And Mike will just be giving us a little bit of an insight in terms of what's happening as far as investment concerned. And secondly, we have the not so hairy beast, the shiny top beast. That's right. Who's John Davis, who's head of the corporate team at Thrings. So, as I said, both Mike and John have a wide range of experience in the corporate market, looking at transactions of all shapes and sizes. John particularly looks at the sort of M&A sector, buying, selling companies, etc. Whereas Mike covers off the investment side of things predominantly, and that's the areas they're going to focus on today. So today we're going to have a proactive webinar. Hopefully, we will be running a couple of polls as we go through the presentations, just to keep you on your toes. And for those of you who are our professional colleagues who have joined, you know, if some of these polls are client specific, but if you just answer them as if you were advising a client or you're a client yourself. That would be really good. They're very general polls, but they just give us a flavour in terms of what people are thinking in the market. Also, there's a there's a little Q&A box on your screen. So please, by all means, if you have a question, please jot it down. I'll endeavour to keep an eye on what's being said, and then perhaps we'll cover those questions off at the end of the formal proceedings. So, in terms of timings, the way things have run in the past, probably about 30 minutes. We'll take up the formal part of proceedings, and then we'll have time for Q&As or just a sort of just general some throwaway stuff that we're thinking as we've gone along and we've thought about. So that's the formal introduction from me over and done with. So Charlotte, you're in the mastermind chair now. You're in the hot seat. So I suppose really private banks should just give us some background in terms of your dealings with them over the last, I don't know, 10 years or so, whatever it might be.
Yeah, so I started acting for private banks in about 2009, predominantly in London and the Channel Islands. And at that time, private banking, it was exactly what everyone expects of a private bank. They were providing, premium banking services to high net worth individuals, landed estates, and the security was, very, very expensive properties, generally in London. And that was it. Sometimes, a big London property portfolio, but that was the focus. Since 2009, that's changed quite a lot. A lot of the private banks I now work with have kind of spread their wings. They will provide services to all sorts of different borrowers. It is still people who have a lot of money, but there's a bit more variety there. And I think, that has come about generally because there's just more scope. Borrowers want those services. They want a bespoke, flexible service. They want to speak to a manager. They want to pick up the phone, speak to someone, and they're willing to pay for it. So that's generally what I've seen that has changed probably over the last 4 to 5 years, and the banks have adjusted accordingly, and they just want to provide a great service.
Mm-hmm. And I guess we've seen them spread out of London, opening regional branches as well. So what have they, what specifically then have they been doing over the last 12 to 18 months, which is this period of lockdown that we've all struggled through?
Yeah, it's been a very interesting one, and I'm sure some of the private bankers that are listening will have kind of their own experiences of what it's been like for them. A lot of the private banks were very traditional and still are very traditional. Their values are traditional values, and they've been around for an awful long time. And I think what's happened to a lot of businesses in the last year, 15 months, they've had to adapt. They've had to become aligned with how their customers are working, because their customers have had to adapt. And I think that's been an interesting experience for a lot of people. Private banks that I work with on a day-to-day basis have had to make a lot of changes. They have really, really had to embrace technology, which is something, I'm not saying all private banks are like this, but it's certainly something that I think, change takes time, and it costs money. And it is something that people haven't had the time to adjust in the same way, and they have done it. They've been incredibly busy. And I think because private banks want the whole point of a private bank, as far as I'm in my experience, the whole point is to provide fantastic service. And the banks that I work with have gone, to all sorts of lengths to ensure they are doing that. They have restructured, they have fully embraced technology, they've changed their entire systems, and a lot of them did do it very quickly because they had to. So it's been a really, really interesting year. And I have to admit that, they've done a great job. They really have. Some banks probably have been better than others. But I have to admit, my clients, have really gone for it, and it's definitely paying off. Definitely paying off.
Okay, great. And I guess what how do you see that developing then over, is that sort of something which you think has just been a reaction to what's happened recently, and perhaps think people will go back into old ways, or do you think there's a permanent change that we're going to see now? No.
Yeah, I mean, I can't see it going back to the way it was. Again, I think it will depend on each individual bank, but I think going forward, as their customers become more technologically minded, banks have to follow, and private banks will we'll just keep having to do that. I think in some ways they don't have much of a choice. I think the businesses out there have to change and have to grow. I think as individuals maybe travel more, or if they're not based in the UK and they can't travel as much, there has to be those changes. And I think going forward, banking in general has to embrace technology in the same way their customers do. I don't think it will go back. I don't think it will. I think it will just keep growing. And I think as people who may have been more traditionally minded, I think as they see the benefits, with things like flexible working, as more and more people see those benefits, I'm hoping people will be more open-minded to embracing new systems and ways of working. They have to be, and I don't think private banks are any different. I think they will be the same.
Brilliant. Okay, thank you, Charlotte. Now I'm just going to run a quick poll, folks, and as I say, just if you could just answer these questions as best you can, that would be brilliant. Right, here we go. I'm just going to launch the polling now. So if everybody could answer that. And I suppose I'll just say a few words. I suppose where I'll pick up, and I come up from the background really of a traditional high street lender, from a joint stock bank. I think if I think it's great to see the expansion of private banks really, because at the end of the day, it provides competition, it provides flexibility in the market, it provides added choice. So it's got to be a good thing really. And if it makes the high street, the larger banks, a little bit more nimble on their feet as a result, because they see what this private banks are doing, then that's great for everybody, isn't it? So so that's good. Right then, I'm just going to end that polling now, and I'll just share the results with everybody. So there we go. So, all right, okay then. So 25% have considered approaching a private bank, but perhaps a large percentage is 63% haven't, and possibly that's because they're not fully aware of the sector at what it does. But then I guess really the leader in terms of what's putting people off using private banks is a perception of cost, perhaps. So I don't know, Charlotte. Do you think those are valid concerns? Or?
Yeah, and it usually that is exactly what it comes down to. It is about cost. I think anyone who uses a private bank will rave about the service that they get. That you do definitely get what you pay for. I deal with the same people day in, day out. I know how they operate. They look after their clients. They really, really do. That is what they're paid to do, and that is what they love doing. And I think that is what you're paying for. And I know that the cost, they definitely see the benefit. I definitely think it is worth people considering. There are great private banks out there, and it's sometimes just worth picking up the phone and having a conversation.
Yeah, well, indeed, if you don't, sometimes if you don't ask them to have these discussions, you don't know what's out there, do you, really? So, brilliant. Okay, well, thank you, Charlotte. That's great to have a little insight of your experience in terms of the private banking sector over the last 10 years or so, and where it's likely to go. So, next into the hot seat, John, I think it's you're up, I think. So, hope you're sitting comfortably. Yes.
Always.
Good. Okay. So I guess, John, it's quite interesting, really. A lot's been said in the press, of the TV, in terms of what's happening in the economy over the course of the COVID pandemic. you and Mike have been at the coalface. What's your experience? What deals, it's been quiet. What deals have been happening? How busy have you been?
Hello, everybody. Some of you will already know me. Some of you won't. I'm glad I can't see you in case your eyes are kind of glazed over when I speak. But John Davis, head the corporate team at Thrings across all of our offices. And if Chris had asked me that question 15 months ago, I suspect my pants would have been on fire, largely because I was terrified that the world may have fallen apart, that M&A, mergers and acquisitions may have fallen apart. Not necessarily because of Thrings, but of course we're lawyers, we provide a service and we're reliant on our clients doing business. And I wasn't sure whether when we all sat in our living rooms watching Boris Johnson terrify us that first night when he said he was closing the country, what impact that might have made. I think it's probably fair to say the first 4 to 6 weeks after that television event was a bit shaky, and I think we were all a little bit concerned. But across the board, and it's probably worth saying, Chris, that Thrings, the corporate work that we do, I would say, is mid-market corporate work. It's not the kind of billion pound deals. We're kind of in the 5 to 30 million mark in terms of the transactions that we do. It's been busy. We've probably had our busiest year. And I was, in preparation for this, I was just looking at some stats. And between January, 1st of January and the end of March alone, across the corporate team in Thrings, we completed 17 transactions. The interesting thing, I suppose, is that they were both sales and acquisitions, but the deal size ranged from sub 1 million all the way up to a few deals which were in excess of 50 million. Another bit of comfort that I took from it was that it wasn't particularly sector specific. And by that, I mean, we did deals in the engineering sector, pharmaceutical, downstream oil, energy, communications, hotels and leisure might surprise you, given what COVID did to hotels and leisure, consultancy business and professional services. I suppose of all that, a number of transactions, I guess, though, really fell on what I would probably call the tech side, technology and software. And it seems to me that in the last 15, 16 months, if you've got a business with the right technology or software platform for somebody, you're in a pretty hot position. The multiples, I'd say, have been strong. I mean, obviously, on the legal side, we don't necessarily involve ourselves in the multiples. We leave that to the corporate finance guys and the accountants to work out what a business may or may not be worth. But we do see the end product that comes out of the sausage machine, and multiples have been reasonably strong, particularly against the background of COVID. So yeah, I mean, we've got some really strong deal throughput. Of those 17 transactions, all of them were completed in that 3-month period. In fairness, some of that was driven by our friend Rishi Sunak and terrifying the world about potential tax changes, but pipeline looks strong as well. So yeah, that was a long answer to a short question. The market was not as bad as I thought it would have been. Mike, anything to add?
The market was as bad as you could think it would be. So there's a slight distinction in what I do as opposed to what John does as sort of bread and butter, in that I'll look often at the investment side of things as opposed to sort of pure M&A. And at the same time that John was sitting in his pants worrying about the world, I was doing the same about the investment market, with probably better reason in terms of pure equity investment. That did slow for a few months. It's very much picked up again now, and particularly in the type of sectors that John's talking about, so technology, software, anything with a bit of a distance element. particularly distance learning or distance selling, that kind of thing. The interesting thing, well, I suppose there are two, but number one was on where I'm talking about the investment market slowing, I'm talking really about new investment. So I'm talking about new private equity predominantly into their lead acquisitions, their flagship acquisitions. Where that flagship acquisition had already happened, there was no sign of slowing. So some of them actually were in a position of strength to go out and look for those 2 or 3 or 4 follow-on acquisitions that build the group, build the synergy, etc. So there was quite a lot of that even within those first, there probably was a 3-4 week gap, but even within the few months following that, there was quite a lot of investment or M&A investment work. The other thing, of course, is that while the investment market fell away, or quietened, I shouldn't say fell away, a new market sprung up in terms of all the government-backed lending, C-bills, CL bills, back investment through Future Fund and that kind of thing, which provided a real stimulus. Well, it provided a real work stream in itself, and I don't by that mean work stream for Thrings. I mean work stream for all industry really, but also provided the comfort which immediately led to M&A picking up again, investment was slightly slower but picking up again, and now both markets look really resilient, really strong.
Good. Okay. So in your experience, and probably this is probably more focused at you, John, I would say, in terms of the deals that you were looking at, how have they been funded? What where's the money coming from?
Not my bank account. That's for sure. Yeah, I mean, a really good patchwork quilt is how I describe it in terms of where the cash has come from on the deals. And it's quite interesting on both sides. When you're acting for a purchaser, you want to be pretty sure that they've got the readies to carry through with the transaction. When you're acting for a seller, similar, you want to make sure that they don't spend 2-3 months trying to sell their business and find out that there's no cash on the table at the end of the deal. But deals have been structured in a way that has seen some really good thinking. Some of the transactions, absolutely, the usual suspects, the big name banks that you would expect to be financing deals. Although I think it's fair to say that a lot of their time was taken up with COVID-related loans, as Mike has just mentioned. For the successful applicants, and many were, those COVID-related monies helped drive the M&A market, because some of that cash was used to fund acquisitions. I mean, quite interesting that, I may be wrong, but I certainly get the impression that some of the companies didn't need that money. It wasn't money that they would have wanted had it not been there, but they've taken it and they've used it wisely. And I always say, when it comes to the main banks, if it's a quality transaction, they'll back it. They'll back it. So yeah, the COVID lending. We've seen a lot of activity in what I think previously, and now disingenuously maybe, you would have called the challenger banks, the kind of challenger institutions. And I say probably disingenuous now because they're pretty busy in the market. They're quite hungry. We're seeing quite a lot of deals where possibly names that you wouldn't have recognized a couple of years ago are the primary source of funding for a transaction. And some of them, I think, probably look at transactions that other institutions may not have wanted to look at because of a certain risk element in there. But they've priced the deals accordingly. And actually, some of the acquirers that we've acted for that have gone down that route have appreciated that. You can't kind of close yourself off to opportunity for the sake of maybe a slightly greater cost. is the view that they've taken. So we've seen quite a bit there. We've seen alternative lenders that are not banks. These are funders effectively who are using capital from international investors and from pension funds. They're very experienced people who are running those teams. They've often come from banks or a corporate finance background. And, certainly what Mike was saying about private equity, we've done a number of transactions where PE have been involved. Interestingly, the ones that I've done haven't been direct investment from PE, but they've been where private equity actually owns a current trading business, and that trading business has wanted to go out and pick off a target because it's strategically right. So the money's come from that PE kind of investment background, but the deal, if you like, the buyer has been a trade buyer. And within all that, and this is where the patchwork quilt comes, Chris, a mix. We've seen a mix of some bank funding, some alternative lending funding, some private equity, sometimes in the same deal. We've also seen vendors funding their own deals, which sounds weird and counterintuitive, but very often a seller will leave some money on the table, a vendor loan, for example, and will be paid out over time, so that the strike price on day one is X million pounds, but the seller only takes Y million with the X to follow. And within that, I think probably 90% of the deals have also had some element of deferred money, deferred consideration, or earnout. And just to explain, I'm sure most of the people on this webinar will know the difference, but deferred consideration, that gives you a contractual right to the cash for your business. It's just kicked down the road a bit, sometimes to help fund a transaction. Earnout is where a buyer bases that deferred element on the performance of the business that they're buying. So they kind of offset some risk on it. But it's been a real eye opener. I think the banks, the financial institutions, the investors have been looking for ways to find solutions. Again, for the right business. If it's quality, there's a deal to be done. Mike, are you going to contradict me?
No, I'd add, particularly in relation to the last point there around vendor financing. I think that's always been a thing in M&A, and deferred and earnout are always relevant. Vendor financing, you've always seen quite a lot of in things like management buyouts. So where lead vendor is bringing on their next team. So it's quite often been a thing that sort of flows down the transaction, if you like. What I've seen in the investment world is that more and more, it's something that flows up the chain as well, particularly in the last 12, 18 months. So there's always been an element, if a PE buyer is coming in, then yes, they're investing in the business, but a very, very key part of that is that they're investing in the management team of that business. I suspect, Chris, you'll be able to talk about that a bit in a minute. But there's always been an element of locking that management team in for a period post-transaction to make sure that the buyer is getting the benefit of that experience and that drive, that understanding of the business and the industry. What we're seeing more and more now in terms of vendor financing is levels of things like equity roll-on or long-term incentive plans, whereby a seller will use part of their purchase price received to then buy shares in the buyer. So they effectively become a part of management within the buyer. They're part funding the transaction through that as well, obviously, but the key there for the buyer is that there's no better incentive, is there, for the sellers to make that synergy work, to make that transaction work.
Yeah, just to jump in on that point, I suppose, really good point. In fact, we've got 3 live ones at the moment where where the vendors are leaving something on the table by way of an equity investment going forward. And just again, many of you on the call will know this, but some won't. That actually brings into play two kinds of transactions. So one is the sale of your business, but on the other side of the fence, you've got a new relationship with a brand new shareholder going forward. So there's as much to and fro and negotiation often on those kind of deals, not on the deal itself, but on what's to come in terms of the relationship between the two parties. I've realised I'm doing quite a bit of a Magnus Pike. Do you remember him?
Yeah.
Old,
sit on your hands.
Indeed, I must.
Well, on that point, then I think it's time for another poll. So I'm just going to run a where have we gone there? There we go. No, sorry. Oh, there we go. Stop showing results. Right, I'm just going to run our next poll.
Do you want me to sing a song while this is? Oh no,
sorry, and there we are. Just technology for you, isn't it? Really. So anyway, whilst that's running, folks, I suppose we'll move on, John. In terms of from your perspective, really, what are the key things that that funders are looking to sort of have completed now before they actually release funds, before they let go of their money?
Before they pull the trigger on the readies, it's quite interesting. I mean. You kind of think that the transaction itself is between the buyer and the seller, but of course, when there's money involved, that's often coming from a third party if it's not coming out of the bank account of the acquiring company or business, and that third party is as interested in the paperwork and the detail as the person spending their money, as the acquirer. So again, just to reiterate, I'd say money is always there for quality. But the money, the bank, the investment house, whoever it may be, the high net worth individual, will be looking quite closely at proven historic financial performance, as you'd expect, and very closely at forecasts going forward. And, it's quite important as a seller that you don't over-egg what you're promising, especially if there's an earn-out attached to the transaction. So obviously financials, but and perhaps you can touch on this in a little bit as well, Chris, with your banking hat on, but they are looking closely, ever more closely at management teams and the strength of the people in the target business, whether that's second tier management who are now going to step up because the owners are leaving, or if it's owners who are staying on for a period of time, but it's having confidence. The money wants confidence that it's invested in the right people as well as the right business. Coming back to what Mike was saying, it's one of the reasons why often the money makes the incumbents stay in place for a period of time after a transaction is completed. Depending on the business, common sense things, they'll be looking at the strength of covenant of your contracts. Have you got long-term contracts in place? Are your contracts tight? If you're telling the money that you've got a 5-year contract, is it a 5-year contract or can it be terminated on a month's notice? Big difference between the two. I spoke at the very start about the kind of hot sectors that we're seeing at the moment: tech, software, distance, as Mike was talking about. They'll be very keen to know that the intellectual property that they're buying is actually owned by the target. That it hasn't been created by a consultant outside of the business or created by a disgruntled employee or ex-employee who's now left. So due diligence, I suppose. And of course, the other thing, if you've got it, it's always very helpful to have an asset. I know it's old-fashioned to say it, but a little bit of brick and mortar goes a long way, doesn't it? So yeah, pretty common sense stuff, but I'll be honest, Chris, I'm a lawyer, you're a banker. What would you have been looking for?
Well, to be honest, funny enough, I'll just share the results of the last poll with everybody, actually. And it's just interesting in terms of what we've said. Virtually, over 80% would normally, if they're looking for funding, they'd go straight to the high street bank where they might have that relationship. So clearly, from a private bank's perspective, there's a lot to go at there. So that's interesting. Right. Okay. If I just stop that poll now, and I will just mention to everybody before I perhaps say a few words. Obviously, if you've got any questions, please raise them in the Q&A box. But I suppose from what you were saying, if I was looking at it with my banking hat on, I said the first thing I would look at is the management team, because at the end of the day, no matter what the company is like, no matter what the product's like, if you don't have faith in your management team, or you feel they can't be trusted, or they haven't got the right balance, or whatever it might be, you are going to walk away from the deal. The management team is absolutely crucial from my perspective. Not far behind it as well is a track record of strong cash generation, because at the end of the day, if you're a banker, sales don't repay your loans, profits don't repay your loans, it's cash that repays your indebtedness, and you've got to have an ability to generate good sustainable cash flows. Very, very important. As John said, if you've got contracted stable revenue streams, you have a great base of customers, base of clients, absolutely fantastic. I'd be always wary if you were just reliant on one product, or you just had a high client concentration. At the end of the day, if you're a one-trick pony, it only takes a pony to come along and do better tricks, and you've had it. So a breadth of offering, very, very important. And I would say if you're looking to either even sell your business or look for funding for acquisition, preparing your business, look at whatever it might be, a 5-year, a 3-year horizon, so that you can really drive your business. So it's like the Olympics. You want to be in peak condition when you are doing that transaction, and that might take you a couple of years to get to that point, but it's key. It's key that the business is in peak condition. It's key that your financials are in peak condition, and it's key that your team are in peak condition as well. And that might be awkward, really, because there might be some people that have been with you for an awfully long time, but if they're not the right people to drive you on to the next stage of the business growth, you're going to have some pretty tough and awkward conversations with people in terms of, as we used to say, who's on the bus with you. You've got to have the right people. And the other thing I would say as well is really be up to speed with your financial reporting requirements. Certainly, so many businesses just run off the back of a QuickBooks P&L or whatever it might be, but you really have to be up to speed with your financial reporting, integrated forecasts, running your sensitivities, so that you know what options are available to you. Expect to be challenged by a funder. Don't go into your shell if someone is really putting the finger on you and asking you to just justify what you're putting down on paper. That's what funders will want to do, and that's what you should be prepared for. And I think we've not mentioned sort of financial covenants and control aspects like that within our talk. Lots of funders will want fairly tight covenants within their lending documentation, and you've got to be certain that you understand those covenants, and you've got to be certain that you can produce the financial information so that you can calculate those covenants. And it might well be, if you might have an FD that's used to doing his VAT returns and his PAYE, but when it gets to things which are slightly more complicated in terms of rolling covenant checks and CAFADs and Lord only knows what, they might struggle. So very, very important that you that you do that. You get your financials and your financial reporting in order. So and that comes from bitter experience, really, in terms of having some people that I've lent money to in the past, and then they've really struggled when it got to the nub of it. So anyway, that's enough of me wittering on, folks. I hope that's been a good sort of selection, good background, a general overview of what's happening in the market. We have got a couple of questions which have come in. One for you, Charlotte. And I don't know whether you want to answer this or not, but we have had a question in terms of, I don't want to put anybody on the spot. Any particular private, someone's asked if you can name some private banks, for example. I wouldn't normally do this to you, but as a question's been asked.
Yeah, I don't know where to start, to be honest. I mean, there are hundreds. You can, type it into Google, private banks in London, and see what happens. Some of them are obviously, there are ones that are affiliated with, the high street lenders, all pretty much have private banking, private banking, parts to them. You've got Coots, Hoare & Co. I know there's a few on the call that I won't name, just to be on the safe side. There's all sorts. Honestly, you can put Private Banks London and you will get a wonderful list. If you want to, and if you do want to speak to any, just drop me an email and I will happily put you in touch with some private banks.
Okay, well, I think we might do that offline then. Right, another question that's come in, and this is, and I think this is a great question to be honest. What's our view really? Do we see commercial brokers playing a more strategic part in raising finance as banks centralise their offices? And obviously, it gives you, using a broker gives you a great opportunity to test the market, leave somebody else do the work for you. What's our thoughts there?
Mike, shall I?
John, over to you.
Mike, I know you're head of the banking and finance team, but just to let you know, of a number of the deals that we completed in the last 18 months, brokers had actually been involved in sourcing the finance for quite a few of them. And where I was talking about the deals which are sometimes slightly different or more complex, or perhaps have an element of risk in them, the kind of brokerage market's been really useful. So I guess that's another longish answer to a shortish question. Yes.
Good. Well, I certainly see it that way, to be honest, because and within the brokerage market, I think there are a lot of very good, well qualified individuals out there that have come from a very solid banking background. Yeah. So there are some good individuals out there in the brokerage market who really know what they're talking about. That's good.
I think that's right, and I think also they can have a different type of conversation, both with bankers and with potential customers as well. So they can get insights into a customer and or into a sector that a banker won't necessarily get on day one. And what that can help to do is that they can help on both sides of the fence in framing the offer or framing the proposition for what the customer is actually looking for, or for what the bank's actually looking for. And a lot of the when you were talking about financial covenants, Chris, for example, a lot of that is a bank trying to control the areas where it sees there's a potential problem or a potential gap. What brokers can do is help to use their experience for the borrower to identify where there's that potential gap, but to have an answer when they're asked about it, and to have a plan as to what they're going to do about it over the 3-year, 5-year period that Chris was talking about, and can therefore make that set of financial covenants a little bit easier on the customer, for example. So yes, I agree with both of you. Basically, I think there definitely is a big role for them going forward.
Brilliant. Okay, I'm just conscious of time. I've got one final question. It's coming your way again, Charlotte. In terms of obviously we've had Mike and John have mentioned in terms of the transactions that they have undertaken. They've seen a lot of the government schemes in operation. What about the private banks? Have they been using sort of CBILS and bounce back loans, etc., or whatever it might be?
No, not that I've seen. Not that I've seen. Sorry. No, not especially. Definitely not come my way. I mean, some of the private bankers listening may have done and might have comments on it, but probably not the right forum for that. But no, it's not something that's cropped up really.
I suppose perhaps from their perspective, they're more focused on the individual that they're lending to rather than the scheme that they lend via, but possibly.
Yeah.
So
yeah, very much so.
Brilliant. Okay. Well, then, folks, that's taken us up to 4:45 now. I'm sure there's a lot of you probably will want to go and get ready for Pointless or some of the other tea time quiz of your choice. So I won't hold you any longer, other than to say thanks very much for joining. It was quite interesting. A couple of weeks ago, I had a chat with Melinda Myers, who's the agent for the Bank of England in the Southwest, and one of the things that she did mention that there was an awful lot of liquidity in the corporate market at the present time, in terms of businesses where, perhaps they'd cut their costs during the pandemic, but their revenues haven't been impacted as much, and they've been generating cash, or they'd applied for government support, and they were just in anticipation of the worst case, and that hadn't come, and they were just sitting on it. So but there's a lot of cash out there. So hopefully over the next 12 months, everybody who was on the call might see either lots of business coming their way, or lots of investment or acquisition opportunities. So let's hope for another strong 12 months. Hope everybody's enjoyed the webinar this afternoon. Have a very pleasant evening in the sunshine, and look forward to seeing you again sometime. Thank you, everyone.
Cheers.
Thanks.